We need to fix the market structure. But I think it's become increasingly clear today that the chain we have today isn't quite ready for that. The idea of application-specific sequencing doesn't work immediately with a single leader. The goal is really to get 20 millisecond block time, and either we rotate or we have multi-leader, so that it's really like 20 millisecond tick rate on the exchange. So we really want to get to 1 million TPS. In review, we're going to get to 1 million TPS, we're going to get to 20 millisecond block times with async execution, and we're going to do the simultaneous multi-leader turbine. That will give us a multi-leader defense against censorship resistance, which gives us application-specific sequencing, which gives us tighter spreads, and then totally what we finally have. Okay, this is a kind of Solana roadmap, Max's vision, but mostly like decoded from what Coley told me. And I had to do significant decoding work, but we managed to recover the block. So here's the basic overview. So the first thing I'll start with is that we're all here basically to build a blockchain where order books can run on chain and be competitive, not with Ethereum, but with things like the New York Stock Exchange, the NASDAQ, the CME, all of these centralized exchanges that are running. So this was like the reason I came over, because that's also what I wanted to build, was basically decentralized NASDAQ. And it's been very clear from day one that that was the goal. And originally it kind of looked like it was going to work pretty well. We had like this chain, it was running. But I think it's become increasingly clear today that the chain we have today isn't quite ready for that. And there's several reasons for that, which I'll get into, but one of them is that we just simply still do not have enough TPS on the chain. So we really want to get to 1 million TPS. One thing I like to say is that 1 million TPS is enough for Visa, MasterCard, Amex, Discover, so all that kind of payment networks. And NASDAQ, CME, New York Stock Exchange, Tokyo Nikkei Index, the Stock Exchange in Tokyo, the Stock Exchange in Singapore, the Stock Exchange in London, in Frankfurt, et cetera. Like you can put basically all of the financial activity that goes on in around 1 million TPS. So that's why it's kind of a good metric. And it's nice that basically 1 million TPS is kind of enough for everything we want to do. So other people at Anza are working really, really hard on this. And we just had SIMD207 go live, which is an increase to 50 million CU. And there's another SIMD256, which Brennan announced, which is in Agave 2.2 release. It's kind of the last feature flag in the feature flag queue right now, is this bump to 60 million CU. And we've committed to be at 100 million CU by the end of the year. So still a ways off from that 1 million mark, but we're getting there. The next thing we need to do is we still need to get the block time down from where it is today. So Bitcoin was 10 minutes, ETH 12 seconds. They've said they're going to go to Beam Chain in 5 years, so they're going to be at 4 seconds. We're already at 400 milliseconds. But for the purpose of MEV, we actually only rotate every 1.6 seconds. So it's more like 1.6 second block time for MEV reasons, which is what I work on. But the goal is really to get 20 millisecond block time, and either we rotate or we have multi-leader, so that it's really like 20 millisecond tick rate on the exchange. So this sounds like really ridiculous, right? Because New York City to Tokyo is 200 milliseconds, and you typically need 2 or 3, 2 in the happy path case, 3 in the slow case, rounds of communication to get consensus. So how am I saying that we're going to get to 20 millisecond block times? Well, the key is that we need to start the process of consensus on block 2 before the process of consensus on block 1 is finished. And so we're going to constantly have if consensus takes, say, 300 milliseconds, we'll have 15 blocks doing consensus at the same time. And we'll be kind of churning through them. And in fact, we might have multi-leader too, so we'll have the number of leaders K times 300 milliseconds over 20. So turns out the key ingredient for this is to completely separate consensus and execution, so that instead of building on the previous bank hash or state root, depending on which language you're talking in, Ether, Solana language. But if you're talking about Solana language as the bank hash, right now we kind of do consensus based on the bank hash. And it turns out you don't actually have to do that. So you can just do consensus on the set of transactions and later agree on the state root. And that allows you to do things like completely make execution async and have 20 millisecond blocks. Feel free to interrupt. I think I have maybe like 45 minutes of content, and we're scheduled for an hour and a half. So hopefully you guys can help me fill some extra time with questions. I think this is like something that we'll probably get when I present this to a broader audience, will be very controversial on Twitter, because there will be these people who like are supposedly the experts at consensus, and they will be telling us that you know, it's impossible. You have to have 3 rounds. It's like, yeah, we know you have to have 3 rounds. We're just going to run, you know, 15 of these at the same time, staggered by 20 milliseconds. Yeah. Okay, the last kind of thing, which is what I'm going to focus the majority of my time on today, is we need to fix the market structure. And what I mean by fix the market structure is, in order to compete with something like a NASDAQ or New York Stock Exchange or CME or Binance or Coinbase, you need better prices. And in markets, prices are decided by how wide the spread is. So this is a snapshot of the first 5 levels on each side of an order book on Binance for SOL USDT, which is Tether spot. And it was taken around midnight, it looks like, maybe. Yeah. I don't know. This one's maybe around noon. And you can see a few elements here. So the green are the cumulative bids. So these are people willing to buy SOL at the prices that they're putting out. The red side is the asks. There are people willing to sell. And the difference between the best bid and the best ask is the spread. In this case, the spread is around 1 cent, which is less than 1/100th of a percent. So BPS is basis points, which is 100th of a percent. Usually we measure these things by that. And so if you're crossing the spread here, usually we think of like the true price is somewhere in the middle of the spread. So you're kind of paying half the spread every time you cross, which is half a cent times the kind of US dollar value of the SOL that you're trading. And if you trade on chain, you're actually getting a much worse price than that. So typically trading on chain, you're getting 4 or 5 bips wide effective. And so you're getting like, in some way, you're getting 5 times worse price trading on chain than you are off chain. And we need to be at or better prices if we really want to compete with NASDAQ. So how do we get that spread down? This is like not a trivial problem, especially given that we have to do consensus on everything, and like the New York Stock Exchange doesn't have to do that. Well, there's 2 things that determine the spread. On the left-hand side of this equation, there's a term which is like how many retail uninformed traders are there coming, and then multiplied by the spread over 2, which is how much money you make. So it's like how much money you make from the retail uninformed guys who you know more about the price than them. So you're making money off every one of those guys. And the right-hand side is like your Jane Streets, your Citadels, your Wintermeats and SCPs and Ergonias, and they're more informed about the price than you when they trade with you. And so when they trade with you, you lose money. And the math here, lambda jump is like the probability that the price suddenly jumps. And then this other stuff is like the expected amount you lose when there's a jump. So that's basically what we're trying to do. So we have two options. We can either increase the number of retail traders by onboarding them. So that's like super team's job. That's not my job. Or we can make the right-hand side of the equation smaller, and then the spread that solves this equation is going to be smaller. And so I'm going to talk about how do we make the right-hand side smaller. But we should know that there's a little bit of a flywheel here. So you get more people who are uninformed trading with you when the spread is smaller, which causes the spread to be smaller. So there's a little bit of a flywheel here, and eventually you find an equilibrium at which the spread equalizes, which in Binance's case is less than a bip, but maybe could be even lower if you made some changes to the market structure. So if you don't make changes to address the right-hand side, then you potentially like stop that flywheel in its tracks before it can get started. And that's kind of what's going on right now is on-chain trading venues like Drift, like Phoenix, like Jupiter, they're all building off-chain systems to actually manage the quotes because they can't do what they want to do on-chain. They can't compete on-chain, so they're making things like Swift, they're making things like JupeRFQ, Phoenix, which is run by Ellipsis, they're just making a whole new L2 because they want a centralized sequencer. So who's making order books on chain is right now moving off chain, which should be a big red flag for us in terms of what the original vision of Solana was to have order books on chain, and everybody who runs an order book is moving off chain. That's pretty bad, right? So we probably need to do something about it. What should we do? So there are kind of two ways to think about volatility in the standard market structure model. You have this true price, which at a trading firm is called, sometimes called the fair, although then they had some regulation issues. So the GCs have told everybody, and most people have moved over to the theoretical price or the Theo, because the idea would be like, oh, we have a fair price and we're trading with you at a price that's worse than that. So that's maybe not good for compliance. So originally it was called a fair, now usually called a Theo for regulatory reasons. And some other people call it sheets. But that's basically what you're seeing here is this mid price is, you can think of as the fair price. And you're always marking out against that price. When that price is inside the bid-ask spread, which is this window, you're not stale. So you're a market maker and you're offering SOL at, let's see, 119.06 maybe. Sorry, you're offering at 119.6 here, and your bid is 119.4. That's like here, and the price is 119.5. So neither your bids or your asks are stale, and you're only going to get filled by retail when they want to trade. So that's really good. So this is like two series of 15-second vol on Binance. And you can see on the left, this was around midnight. On the right was around 12:30. And if you're in the world on the left, the market maker's just printing money here because they're kind of never getting filled by toxic takers. On the right, you can see there's a lot of volatility. There's a lot of times when the Theo is outside of the bid-ask spread. And those are the times when you're losing money. And when you see something like this kind of jump that happened, you kind of lose the square of how far outside of the bid-ask spread you are. So when it moves a lot, like this case was, this was like 30 basis points, and you're making half a basis point on every retail trade. So you can imagine like you're losing 30 basis points on this trade, and you're making half a basis point on a retail trade. You have to like have a lot more good retail trades than bad adverse selection like this. And this is just showing that jump that you saw on the previous slide. So this is like what happened after this jump. The new theoretical price is shown in blue, and the old one is shown in dashed blue. And you can see how much liquidity is stale. And this is actually because I only have the first 5 levels here, so I only have the first 5 asks here. There's actually way more asks. There's like 50 levels of asks from the mid here to the new fair price. And so there's actually way more liquidity than is pictured here. So it says only 350 SOL, but it's more like 5,000 SOL. And that's all getting picked off at 30 bips. So you're going to need retail traders coming in, trading 5,000 SOL times 60. So you kind of need like a ton of retail volume to outdo this one bad trade. And that's kind of what we're trying to avoid, right? It's like, how can we protect retail from these how can we protect market makers from these really bad trades so that instead of having to charge retail half a basis point, they can charge retail, less than half a basis point, maybe a tenth of a basis point. And then, of course, we get more retail coming in, and we can charge even lower spreads, etc. So in central limit order books, there's been some very nice research on this. After a jump like what we just saw happens, there's a race. And the race is very often won by the people who are taking. So if you're the market maker, you have your quote out, it's stale, you're one person trying to cancel, and there's like 10 other firms trying to take you. So the simple model turns out to be a pretty good one, which is just that you randomly arrive and you successfully cancel about 1/10 of the time, which is pretty bad, right? We can probably do better than 1/10 cancel. And on the right here, this is just kind of interesting because they're like the top 6 firms. You can see that the top 6 firms are actually more likely to be taking than making. And there's a bunch of firms not in the top 6 who are mostly doing making. So the top 6 firms like Jump and Jane Street and Citadel actually make more money off of taking than they do off of making, except when they're buying private flow, in which case they don't have to worry about adverse selection. So they make a ton of money off that too. So here's kind of a simple model of how that might look. You have a price jump like the one we saw. All your takers come in, and the maker also tries to come in. And on NASDAQ, it's just first come, first serve. And for a while on Solana, like in the serum days, early serum days, this is kind of what it looked like. But that's not incentive compatible. So of course they started to run something else, which was Geo, right? They said, I'm the proposer, I'm a monopolist for 1.6 seconds. I might as well, since this economically valuable activity is going on, I might as well take a little piece of it, which makes sense because that's the rational thing to do. And we've ended up with a market structure today, which is basically this auction style of market structure. And even though here taker 1 arrived first, because his bid was lower in the Jito auction, taker 2 is the one who won. And in order for the market structure to be good, we really want the maker to win. So what if the maker just bids higher? Well, now the maker ends up paying adverse selection costs anyway. So even if the maker wins the Jito auction, it's not a good outcome because he's still getting taxed, in this case, $6 by the validator, which is almost the same as if a taker had just taken him and he lost $6 from the adverse selection. So Jito auction, nothing wrong with Jito, to be clear, but it's a really bad market structure for making markets work on chain. And the reason is because it kind of gives the takers a head start. So we want to make makers win more often, and Jito auction is actually making takers win more often. So I said before, the probability of races won by takes this is from the London Exchange, is the FTSE is like the top 100, it's like the S&P 500, but 100 stocks in England. And they're winning about 13% of the time there. The cancels are winning 13% of the time. Okay, on Solana today, I asked some market makers, and they said, no more questions like this for the for the sanctity of the chain. So basically, they're canceling successfully at a rate of about 0. There's a raised hand. Any questions?
Yeah, just a quick question. Do you think this G2 auction period, or the fact that actually G2 made something like this, was working against retailers, or quote unquote giving advantage to the ones that are hunting those trades?
Like, is
Or
it
it's just an unrelated consequence of having a G2 auction?
So, I guess, are you saying, is there a motive here, or what is the outcome?
Yeah, something like that. Something like that.
I think very clearly the G2 is not trying to like wreck users. So I'm not trying to imply that. This is a consequence of the architecture of the chain and the incentives. And if G2 didn't do it, somebody else would do it. So we see things like PAL, and we see things, even Firedancer now has in their implementation, they have a waiting period. We have a waiting period also in Agave, although it's slightly shorter than the Firedancer waiting period. But it's just a consequence of, people run the software that makes them the most money because they're profit seeking and everybody likes to make money. And so I always like to live by the philosophy of don't hate the player, hate the game. So if the game is poorly designed, usually that's my fault. So I should fix the game rather than, saying, oh, these people are screwing over retail. It's very clear that this is resulting in higher spreads, but I don't think that's G2's intention. Their intention is to run a business, and there's money on the table. So if they don't pick it up, somebody else will. Does that answer the question?
Thanks.
Okay, cool. So that's like G2, and it doesn't really matter if the cancel comes first, because this is also a very bad outcome for the purpose of the market structure. You're still getting a huge tax. So what can you do to solve this? So if you are an app designer, you might say, what I'd like to do is any order that the cancels and takes come in, I will just put the cancel first. So as long as they're in the same block, if the cancel comes first, I'll process it first. And this is something that's nice because it allows you to jam the cancels. And now instead of winning 13% of the time, maybe you're winning 99% of the time. Okay, that sounds pretty good. And this is, by the way, like how Hyperliquid works. Of course, Hyperliquid is a centralized server, so they have a trusted validator set, so they can enforce this. We don't have a trusted validator set. We have Ari in the validator set. We have Brian Long in the validator set. No, we can trust Brian probably, but we can't trust Ari for sure. And there's other people who we definitely can't trust. And everybody's profit seeking. So we don't get to do this. Like if you're an L2, you get to do this for free. We don't get to do it for free. Why? Because if you have if Ari in the validator set and he cancels, he like doesn't see the cancel, or he says he doesn't see the cancel, then the takers win anyway. And he can be bribed not to include the cancel. So this is like why the idea of application-specific sequencing doesn't work immediately with a single leader. What you really need is you need multiple leaders. Here's a depiction of this. So the maker sends to 3 different leaders. Leader 1 cancels him, but leader 2 and 3 include him. And the result is that the market maker's cancel makes it into the block. And because we have application-specific sequencing, enforcement, and replay, the maker wins. Okay. Any questions on this? This is like why I've been thinking about multi-leader for a long time, is because we want to fix the market structure.
Brian?
Hey, Max.
What's up?
So when you're thinking multi-leader, are you thinking like this, where it's a 2 out of 3 consensus? Or how does that How does it work to resolve the different blocks that have been submitted by the different leaders?
Okay, very good question. So the
Get a slide for that. All right.
thankfully I thought of this. The idea is we are going to have 3 proposers here, and making it into any one block will make you into the final execution block. And originally, I think Tolly wrote this post that was kind of talking about some crazy merge rule that used proof of history ticks. And if it were up to me, we would not have proof of history in the protocol today. But I didn't want to add it again for something else because I want to get rid of it. So here's a much simpler rule, which is take all the transactions and all the blocks, take their union, which means we're going to deduplicate any of them. Here, you can see transaction A is in block 1 and block 3, transaction B is in block 2 and block 3. So deduplicate them and then sort them in descending order of priority fee. Maybe have a tie break based on the signature or something. And then execute them in order. And execute them in order is waving away a little bit of complexity here, but there's some kind of non-blocking priority respecting queues that allow you to still parallelize the execution of the block, but achieve a very similar result here, which is that if 2 people are trying to access the same account state, then the one that pays the higher fee gets there first. So at first, this doesn't sound like it's full application specific sequencing. It kind of sounds like we're returning to an auction world. But if we add one more ingredient, which is that we add a syscall where the contract can read the priority fee, then apps can read the priority fee and they can set conditional logic based on it. So one example of that might be you set a maximum fee threshold for take orders. So here it's like 100 lamb ports, say. And if you're above 100 lamb ports and you're a take order, we'll just fail the transaction. So we just assert that the priority fee, so go read the priority fee and assert that it's below 100 if it's a take order. Easy check that we can do. And all you have to do is add this priority fee, which is already part of consensus, to SVM, or allow it to be read by the SVM contract or program. Okay. And then if you want to cancel, you can just set 101 lamb port priority fee, and you will automatically get in before any take is possible to execute. So that's kind of exactly what we wanted to do with application-specific sequencing. By the way, I originally called this execution flags. App-specific sequencing, I call it execution flags originally. And some genius on Twitter who likes to take my things and make crude acronyms out of it, called it application-specific sequencing, which he quickly abbreviated to ASS, and then proceeded to post Iggy Azalea pictures on the timeline to shill it. So the question was, does this remove local fee markets? So this is part of the complexity that I'm waving away because we have a lot of complexity in here already. But in the ordering rule, we won't just execute in order because that'll be single-threaded. We actually want to execute in some multi-threaded version of this that does respect priority fee. So there will still be a local fee market in the same way that there is today. We have this priority graph looking thing or greedy, depending on which scheduler you use. And both of those have an element of local fee markets to them. And we might even still have the per account C limit as well. So what are the implications of multi-leader to validator profitability? This is a very good question. In order to get this to work, say we paid the validator the priority fee. Now this sounds great, except then the validator can pay himself a high priority fee and move himself up higher in the block. So it completely misses the point of the entire thing, which is to get application-specific sequencing. So if we let the validators collect priority fees here, then we're not going to get any of the properties that we're trying to achieve. We have to burn the priority fee. and let the protocol do the ordering. When we let the protocol do the ordering, it can delegate it to the apps, and that's how we get markets on chain. Are apps and MCL perfectly mutually exclusive? I would say it's the opposite. It's like if you have application-specific sequencing is only possible with MCL because it's possible, like in this one, we have application-specific sequencing, but so we're going to process any cancels we see on the block first, but the leader decides not to include the cancels because he says, I didn't see it. And so even though you're trying to do application-specific sequencing, the leader still has a lot of control over which transactions go first or second, because he can just, anything he wants to go later, he just doesn't put in the block. Does that make sense? So yeah, so we're going back to burning priority fees. Priority fees are 100% incentive compatible today, and they're 100% not incentive compatible in priority ordering world. So that is just how it works. I was very supportive of 96 because it's incentive compatible for a single leader, and I'm very much saying, you know, you have to do this other way for. So back to the question of like, okay, how do validators make money here? So the goal is to make a chain that has way, way, way more transactions because we have actual financial activity going on chain. So going back all the way to this slide, 1 million TPS. 1 million TPS at 0.2 of a cent per transaction is $60 billion a year in revenue. I think that's plenty of revenue for validators, and everybody can eat in that world. But in order to get to 1 million TPS, we need a chain that is like, we want these 70,000 TPS that NASDAQ is doing to be on our chain. And we want the 110,000 TPS that CME is doing every day to be on our chain. And then we can get to charging them each, you know, 0.2 of a cent per transaction, which is really not that much. And we can get to a $60 billion a year of revenue, which will go to the validators in the form of inclusion fees. So you'll have an inclusion fee and an ordering fee. The ordering fee is burned, and the inclusion fee is paid by the users to the validators. So the inclusion fee is not. I believe I chatted with some of the people who did the syscall stuff. Sorry, there's a question. Is a SIMD or proposal already ready to get priority fees on chain? With the link to the get epoch stake syscall. There is not currently a SIMD, although I've had discussions with a lot of the people who at Anza who've implemented the other syscalls, and we think it will be probably one of the easiest parts of the multi-proposer roadmap to do will be the syscall get transaction metadata, which includes a fee. What's the theoretical block time to achieve Solana future? I hope we can get down to 20 milliseconds. Okay. Shall we chat about how to actually do the consensus? Can we, for 1 second, can we talk about did I answer all the questions on validator economics? Validators will make money off inclusion, not based on wrecking users and makers and making spreads wider. And in doing so, there will be way, way more activity on chain because their users are not getting wrecked.
Max, can I ask you a question about that statement? Just because I'm always the one who says, you know, how can you extrapolate to a future where that is the condition and people are going to try to game it? I mean, what are some of the gaming practices you think people will try to still, you know, get an unfair advantage?
Yeah, I guess there's a lot of things we can think about. It's kind of like, I would say the design of the current blockchain did not consider MEV whatsoever. And it's like very apparent that this was true for ETH, this was also true for Solana, It was just like, oh, we can make the chain faster and do first come, first serve. And originally people didn't even think that Solana would have MEV, right? So you have to design it with that in mind. So that's what we're doing here. And so every kind of part of this design that I'm talking about is very much thinking from how do we break this? I mean, that's kind of how like we as mechanism designers think. And so you'll see like one of the properties that we're really trying to get is this thing called simultaneous release, which means we have multiple leaders and no leader can propose a block with information from another person's block. So if we're simultaneously proposing Jeff and me, I can't look at Jeff's block, see the DEX trades, and then sandwich them. So that's part of like what you're going to see in the next few slides is, you know, how do we get that property? There's still going to be like, you still want to release as late as possible. That's kind of inevitable in these proof of stake systems that already exist today. But it's like, the question is how much of an incentive is there, and like what is the actual impact on the spreads on chain? Not is there an incentive to do that? Yes, there is, but what does it mean for on-chain spreads? Ryan?
Yeah, I've got a question. It's kind of a smell test question. So with the goal of trying to hit 1 million TPS, when I think of NASDAQ and when I think of Visa and some of the other large brands that we've been talking about, in my mind, I'm envisioning data centers with lots of computers and lots of people to manage those computers. And that all those computers are running concurrently and they're doing a whole lot of work. And so the smell test is saying, okay, currently with Solana, the design is we have a single leader, which is running a single computer most of the time on a single CPU. That doesn't pass the smell test to say, hey, we can get that to go to 1 million. So we're talking now multiple concurrent leaders. That's great, because certainly we can go from 1 to 2 or 3. But I'm wondering, how do we reconcile that? You know, that we can get to a place where we can actually manage 1 million TPS. Certainly we can't do it with the current architecture. I think we agree on that. But what thoughts do you have there?
Yeah, so there's a few things here. First of all, with multi-leader, you have more input bandwidth to each, like to the total number of people who can include transactions. It's not bottlenecked by a single leader anymore. Mm-hmm. That's good. And the output bandwidth is similarly less constrained because we have more leaders. So the way this will work, it's going to be at 20 millisecond rate. It's going to be so fast that if you're in Tokyo, you send to the Tokyo leader. You don't send to the New York leader. Mm-hmm. Today, if you're in Tokyo, you send to whoever's the leader, whether they're in New York, London, Frankfurt, or Tokyo, or Singapore. You know, in this world, there's going to be a leader that's nearby, or maybe a few, and you're going to send to those leaders and not to the guy in New York. That doesn't necessarily answer your question because we still have to execute everything. But I think execution right now is not necessarily the bottleneck. I have a lot of ideas on how we can get to like 1 million TPS with execution. It's maybe a whole other talk. I have a paper coming out about it that we just finished, but yeah, it's kind of like a separate issue, which is like, can we do these things parallelized? Can we deal with adversaries who try to pack the block with really like very skewed blocks that use a bunch of memory bandwidth, etc. So you need to do multi-dimensional fees for that. I guess I'll say like that seems, at least 1 million doesn't seem out of the question.
Right. Right. Yeah.
The thing like maybe 10 million seems a little hard. 100 million seems really hard. I always say that ETH is kind of this, they have this take, right? This is kind of an ETH take, which is like, oh, well, don't put everything on one box. Like you can't possibly fit it all. It's like, okay, hold my beer, watch this. Alessandro will say, hold my beer, Vitalik. It's not a good idea if you're running away from a bear and you like take out your binoculars and you see that there's 1,000 miles away, there's a cliff that you're gonna run into, to just stop running and like try to build an airplane because you're gonna get mauled by the bear. And that's kind of where I think we're at, is we're not running into any fundamental scaling limits. We're running into a bug in the Agave turbine implementation. And when we pass that, we can increase the CU limit. When we start getting to the point where it gets harder and the CU limits aren't coming as easily, we can start to have that conversation. But I think it's way off in the distance, so we might as well just like pick all the low-hanging fruit before worrying about building a ladder to get to the higher hanging fruit.
Yeah. Yeah, I agree with all that. I think the other thing is our assumption about the validators will change, that it's no longer a single box on a single CPU. And my validator, for example, could be an entire rack in that world, right? So a lot of computers working together. So anyway, cool. Thank you.
Compute will get cheaper too.
Yeah.
Okay. I'll talk now about how to do the consensus. So this is a review of my favorite part of the Solana protocol, which is turbine. So the leader takes a block and shreds it into 64 shreds. Technically, you do this slice by slice. So every time you get 32 packets worth of transactions, you compute an FEC set, which is 64 shreds. 32 of those are data right now, and 32 are coding. We're going to make them all coding so that they're all the same. And you need 32 of them to reconstruct the block. You send each of these shreds to one relay, who is chosen randomly by stake weight with replacement. So you can be chosen twice as a relay. And then you send to everybody in the validator set. So this is like a little bit of a simpler version than what we do today, although it's what we'll do in the future because it's faster. Today, you have a maximum that you will send to of 200. So you have maybe multiple rounds of turbine. But in the future, we'll just have 2 layers because that's the fastest way to do it. And yeah, this is like, turbine is very underappreciated, I think, in the entire industry because it's pretty much like a paradigm shift in how the block gets out. The block gets out faster, the block gets out more reliably, and the time at which the block arrives is just because of the way that the central limit theorem for order statistics works. Actually, a lot of the validators get it about at the same time as each other, which is a really good property when you go into another, like you kind of get the block and then you go into this consensus phase. So consensus is agreeing that you agree on something, and it's way easier to agree that you agree on something when you start off already in agreement. When you start off like half the people think the block arrived on time and half don't, that's when you have a fork. And so turbine kind of reduces forking because of just like, if you just do the math, it just does that. So that's kind of cool. And then we're going to take turbine and we're going to make it even cooler, which is we're going to use it as a way to do threshold encryption. So with minimal changes, it will give us the simultaneous release property I was talking about earlier. So each leader creates a block. They create some shreds for those blocks. And then they broadcast those to the relays. The relays tell a single consensus leader which shreds they have received. So they have a signed I have message, which says, I have shred 1 from leader 1, leader 2, and leader 3. Okay, now the consensus leader packs those into a block, and he has to propose a certain amount of them. So these are kind of security parameters that you can tune, but say he has to include 80% I have messages from the relays. And then his packed block doesn't have any transaction data. It just says what is available to the network. He sends that out to the validators, and then we do consensus on this. So we do like another round of consensus after that. And once we are done with that, once the packed block is out, now the relays can release. And there's a slight optimization that can happen, and the relay can have a box. Say the relay can have like instances in New York City, Tokyo, and London or Amsterdam, and they can be broadcasting their shreds to their local versions in each of the cities. And then when it's time to release, the release happens very quickly because the shreds are already like local in the region. They don't have to be sent after that. So we're adding like 1.5 rounds of communication in order to get the simultaneous release. But I think it's kind of worth it overall for the market structure, and maybe we can get it down even more. So the first version we had was 6 rounds, which was 3 rounds longer. And then we very quickly were able to remove 1.5 rounds. And we might be able to remove 1 more round depending on what we want to do with, like, it's kind of a security trade-off to remove the last round. So then it might be only half a round more. But that's basically how it works. That's in review. We're going to get to 1 million TPS. We're going to get to 20 millisecond block times with async execution, and we're going to do the simultaneous multi-leader turbine that will give us a multi-leader defense against censorship resistance, which gives us application-specific sequencing, which gives us tighter spreads, and then totally will be finally happy.
But will he?
I don't know.
No one ever wants to be fully happy around here. I mean, that's death. That's complacency.
Yeah. 20 millisecond block times, then we go to 10 milliseconds and 5 after that.
I have a question. It may or may not be related, so excuse me if it's not. You know, we've been diving in a lot with the magic block ephemeral rollup, which does achieve some pretty wild speeds. Is that anything you guys have looked at all?
Sorry, what was it?
The magic block ephemeral rollup that basically can transmit stuff very fast. Right now, they're showing like 15 to 20 millisecond pumping pith price feeds to applications.
Oh, I haven't looked too much into that, but certainly if you have censorship resistance. So another thing about so censorship resistance isn't just about this one motivating example. So I give this example because it's like the simplest thing to understand. But we actually started out writing a paper about running auctions. So in auctions, you might censor bids, which is maybe even worse than censoring a cancel. And in other cases, there are like other things you can do. So for example, if you want to do some liquidations, you might want to keep the pith oracle off. So it doesn't matter that the pith oracle is being sprayed every 1 millisecond if it doesn't make it on chain. And it doesn't need to make it on chain if there's only a single leader, right? One thing you might want to do if you're an oracle, an application that uses an oracle, is you might want to say, if the oracle update is in the block, please process it before anything else. Okay, you can do that with priority ordering. Same way here. You just say like, okay, the maximum fee is this unless you're an oracle update. And then the oracle update sets like 1 lamp port higher than that. So I guess I would say like it's great to have like the oracle feeds going out, but if they can't make it into the block, it doesn't matter at all. And so if you want to build an oracle specific application, then you also need this kind of censorship resistance style, and you also need some form of application specific sequencing too.
Wow. So, I mean, I'm kind of mind blown. I knew about some of this stuff, but it is very interesting to hear it from somebody who knows it a lot better than I do. Questions from folks in the room? Let's open it up. Wow. Yeah, go ahead, Prince.
Yeah. So you made mention of separating execution layer from the consensus layer for you to be able to achieve this sort of speed, which is very impressive. I mean, since it's even way less than speed of light, you know, how does this like differentiate from, say, a layer 2, where you're also separating the execution layer from the consensus layer? Because I know there've been this banter going on for a while now about if layer 2 is actually very necessary on the SVM, or you could just scale with layer 1, right? So what we're trying to do here is it scaling the layer 1 or setting up an architecture where you can actually build off on and maybe build other layer 2s, right? I'm not sure if my point is actually clear, or you actually get what I'm trying to say here.
Yeah, I guess for me, the difference between L2s and L1s that's most noticeable is that the L2s have a centralized sequencer today. And this will not have a centralized sequencer. In some ways, it'll be similar in that we'll agree on a set of ordered transactions and not on the state root. And so that's kind of what L2s do. But it's not that different. So a set of ordered transactions, each transaction maps the prior state to the next state and their functions, so you can compose them all. And so block is just like the composition of all of these state transition functions together. And right now we agree on the function and on the input to the function. And in an async execution world, we're just going to agree on the composition of those transactions. And we don't know the prior state yet because the consensus in the previous round has not completed. So we can only agree on the function. And later, when we know what the prior state is, we will apply that function to the prior state. And that's in some ways similar to what a rollup is doing, in that the rollup is going to propose a state transition and prove that the function was like a valid function. But I guess I would say it doesn't really matter what the label is. Like this is scaled in the L1 for sure. It's decentralized sequencing, multi-leader sequencing. Yep.
All right. So say we're doing the ordering on the execution layer, right? And you can actually have a scenario with the multi-leaders producing block or proposing block, where you can have like a block proposer create and broadcast multiple conflicting blocks for, let's say, for the same height or slot, which sort of violates the current constraints we have now that one block should be proposed per round. I think that's actually called proposal equivocation, if I'm correct. How do you see this happening in this scenario where you have a multi-leader setup? Do you think there is a likelihood for proposal equivocations to happen?
Okay, this is like a very subtle point, but a good question. So suppose that leader 1 wants to propose 2 different blocks in this world. He needs to compute 2 blocks and then compute 2 different sets of shreds. The validity condition for the block being packed is that at least some percentage, the coding rate, so for 32 data, 64 total, the coding rate is 1/2 plus F. So if F is 1/3, then it's like 83%. So you need 83% of the I have messages to include the shreds. So it's actually like, as long as the leader, the relays here are 2/3 of them are honest, then it's impossible to have any equivocation of execution, like of transaction blocks in the packed block. And there's like another thing, which is that it's going to be very easy to detect because we have these chained Merkle shreds. So you sign the Merkle root of the whole shred set, and that's included with every shred. So if you try to equivocate, the only way you can do that without getting it detected is to have a hash collision. And so if you can compute a hash collision at will, then you can make some kind of nasty stuff happen, but it's not impossible to recover from it. Like it will just make the block look weird. It will not have any adverse effects on the network. We'll just like make the block fail to recover. But again, you can only do that with a hash collision. So, I guess that's for we can set the security parameter higher for that.
Nice.
Sorry, I don't know if that answered the question. This is like a very complicated point, but it's a good point. We spent a lot of time thinking about that exact question.
Yeah, I think you actually did. The only question now would be, what would be the disadvantage of, say, relying on cryptographic evidence in the course for detecting this sort of behavior? Yeah, but I think slashing does seem like a good way to go. I mean, relying on cryptographic evidence alone, there might, well, I see how that can be unbeatable. Yeah,
well,
thanks.
What we have is a guarantee that if 2f+1 relays are honest, like 2f+1 fraction of the relays are honest, equivocation is impossible. And if they're not, so if the kind of Byzantine assumption is violated, we'll be able to slash them. So today on Solana, all we have is an agreement that says, like, we have safety and liveness if 2f+1 are honest. We don't have the accountability part. So this is an even stronger version. There's a paper called Accountable Safety Implies Finality. What we're saying here is kind of an even stronger version of, like, it works if sufficient fraction are honest. And if it doesn't work, first of all, it fails pretty gracefully, and we can slash. So that's the TLDR, I guess.
That's interesting. I mean, the slashing thing is something that people do talk about a good amount. Berg, what's your question?
Yeah, I just wanted to talk about the magic block rollup. I also understand that one of the most important things is censorship resistance. And if you think about that, magic block also has its own little verifying network to actually verify the proof that's are sent to the main chain. So I would not think that you could move everything from this to magic block. So it's a really good point to have at least 2/3 of the validators be honest, and that already means a huge number, quote unquote. So yeah, just I'm still thinking on how could we utilize magic block in this case. But I think the most important one should be on the L1. So.
And you know me, Berg, like I'm the kind of guy that say that tastes good, that tastes good. I wonder what they taste like mashed together, and they don't always go.
Not. But I think just one more. So I think when we are getting to the 20 millisecond block time, then we're gonna also have to talk about actually data centers and allocation, because that's I don't know how much 00 can solve on this networking problem, but the distance is still, I imagine, to pump on a few milliseconds on everything. So yeah, a lot of curious things.
Yeah, I guess the point of the 20 milliseconds is we're not going to finish consensus in 20 milliseconds. So you can see here I have like this this outlook, which is maybe we take 80 milliseconds to sum through turbine, then we take another 80 milliseconds to notarize, and then we take another 80 milliseconds to confirm. So we're not like, we're increasing the number of votes by a factor of, let's see, 20 from today. But the dominant thing should be the transactions through turbine. And it's easily tunable how big those blocks are. So the votes are actually should not be, they're not large, they're like 1 packet each. And the turbine stuff is like should way be the dominant factor. And so even 20x vote costs as long as we fix gossip, shouldn't be that big of an issue. So we have much higher overhead for votes, but not necessarily any higher overhead for turbine, because we can make each of these blocks smaller. If we, like, we're not going to try and push the entire block that we would make today through in 20 milliseconds here. We're going to divide the size of the block. Like, it would be what is an individual slice right now would be the size of these blocks, essentially.
Yeah.
Or maybe a few slices, but it would be kind of not like you're not trying to push the whole block through each of these.
I mean,
So
if
you'll
you look
definitely
at,
have more votes, but you will not have more turbine traffic.
if you look at increasing, the compute units per block, you sooner or later we're gonna get there that one piece of this block, what you want to do in the future, we'll already have like, few million compute units that you can use.
Right. What really matters is not like the CU limit per block, but the CU limit per second. And so if you reduce the CU limit per each block, we have 20 times more blocks that like you have more CU limit per second. So that's the
Makes sense.
Saragami, what was your question about? You want to unmute yourself?
Yeah. Hi, Jeff.
Hi.
So that was a very great talk. It was very insightful. And I was just thinking about how this, I mean, it will require a lot of time and a lot of technical expertise if nothing has been going on until now. I was just asking how, I mean, during your course of research, you probably knew, like, you probably saw a few things that might impose this implementation, might oppose the implementation, or might not really be feasible, basically. And it might not even be like cost on the cost side, it might just be, I don't know, maybe the proposal won't pass or something. I'm just asking you now, what do you think will be the bottlenecks to this implementation? And I also didn't really get how the priority fees, making like setting the making higher priority fees go first. I mean, it still somehow goes back to staking power. I didn't really get that.
Yeah, okay. Maybe I'll answer the second question first. So I think what you're saying is basically we have a GTO auction period right now, and if we just did priority ordering, we would have basically another auction, which would be, instead of GTO running it, it'd be the protocol running it. This is very true, but the key is this slide, which is you implement a new syscall, read transaction metadata. So the program can now read the transaction metadata and execute conditional logic based on that. And so if you want to make the takes happen after the cancels, you say the highest ordering fee, which I will allow you to set on a take order, is 100 land ports. So if you set higher than that, I will read the priority fee. I will assert that your priority fee is below or equal to 100 land port, and I will fail you if it's over that, right? Does that make sense?
Oh yes, for some reason I did not see this slide. Maybe it was when my network went out, but this explains it.
Yeah. But yeah, good question. The other question, what do I see are the biggest blockers technically and politically? I think the biggest rock to move is this async stuff. That's where I think like, oh, why does this fail? There's two reasons it fails. One is we can't move to async ever. Like, people have been trying to do this for 4 years now. It used to be called bankless leader in like 4 years ago. And we're not meaningfully closer today to async than we were then. I would argue in some ways some of the proposals have gone about it a little bit wrong, but that's kind of my biggest worry on the technical side is, can we get everybody on board with async? And it is a little bit of a short-term sacrifice. It's kind of like we short-term don't get to do this thing where we just like juice CU limit or remove CU limit entirely, which will delay us from getting to 1 million TPS. But in the long term, we get to do things like 20 millisecond block times and multi-liter. So I think it's worth it. But part of that is like, hey, convincing, at some point in Salt Lake Core Dev, which was almost 3 months ago now, there was some skepticism from financer people. I think some of that's still there, but some of it has been alleviated partly by talking about what it unlocks. So that's the kind of technical side of things. And then I think we talked about already, what is the biggest political issue? Well, we're going to burn the priority ordering fees. So we're going to take MEV away from validators. And MEV is bad, so that's good for the network, but it's not good if you're making a living off of MEV. So, validators and people who are making money off operating validators or people who are making money off of MEV might not be so happy with that change from a monitor's perspective. Even if they think it's the best thing for the network, they might still not vote for it. And it turns out validators vote for stuff. So my hope is that we can make the decision that's right for the network. And I think actually making this decision will be better for everybody in the long run because we will grow the pie. Validators will have a smaller slice of a much larger pie and it will be better for them. But asking for that, it's a little bit of a leap of faith, like they have a good business going. But what I would tell them is that if you do not make this change, then all of the MEV on the chain will go away because all of the applications, like they're already doing, will move the MEV sensitive logic off chain anyway. So you have two choices. You can bleed them out, they'll move, you will lose the MEV anyway. Or you can let them in, let them order their own transactions, and they will stay on the L1, and at least you will get the inclusion fee. You won't even get the inclusion fee if they move off chain completely.
Yeah.
Which is what they're doing already.
All trade-offs.
That's gonna be one hell of a fight. It'll be worth fighting though, for sure. Yeah.
Yeah.
Mm-hmm. Daniel, did you have a question?
Yeah, I wanted to confirm something. So while you were talking, Max, you said something about the validators being processing orders from a region. Is that correct? Where you said if someone is on Tokyo, the validator. So let's say we start with 3, and we have we place the validators in the places we have much more demand. What would happen if a validator is, let's say, dormant? And what would happen if a validator has too many transactions to process? Because I mean, having the regional validators placed would help with latency, but I'm thinking how this is going to work in places of overload or little load, that kind of thing.
Yeah, I think, well, first of all, I think you should compare it to what we would get in a single leader world. So what happens if there's too many transactions in a single leader world? Well, the single leader charges the monopolist price, which is higher than the market clearing price. So you'll raise prices. And if the single leader goes down, then you literally just don't have any new transactions getting on chain. In a multi-leader world, if there's a lot of transactions, then there's competition. So at least there might be multiple validators in Tokyo, and there's a lot of transactions coming from Tokyo because there was a Binance movement. Binance servers are in Tokyo. Then you will have a market clearing price, which is the competitive equilibrium price, which is lower than the monopoly price. So if there's congestion, fees will actually be lower because of competition. And if one of them goes down, well, the other one's still online.
I mean, let's say for one that it's down, is there a mechanism to route to the other available validators?
Yeah, if it's down, then there's other validators who can include you. Might as well send to that.
All right. All right.
So, I always like to ask this question, Max, just because it's, it helps us think about, how we can be of service here. From either a research or a technical side, if you were to encourage the people in this room to look at anything closely with an eye towards contributing, or at least trying to contribute, because it is our process, what are some things like on a wish list, either from a technical standpoint or a research standpoint, that people here can try to sink their teeth into?
Yeah, I guess I would say, so there's this complexity that I waved away here in the ordering. We want a non-blocking queue, which is multi-threaded, which is, yeah, solving async execution would be great. Would be happy for any help there. I'll talk a little bit about how that might be possible. But there's this kind of problem that MathSor was doing a little bit of poking around in. I kind of think that this is not the hard part, at least right now. Maybe it will become the hard part when we solve the other stuff. But there's some, optimizations to happen here so that we can make the execution as parallelizable as possible while respecting the priority ordering, which is a tractable and possible problem. It's more about reading the literature. At some point I read the whole textbook on these non-blocking queues, and they're not very nice, but they do work. This is what my computer is doing as I'm recording this, is having some non-blocking priority queue. And they even have stuff there's a version of the queue, it's called real time. So you're running a software like an airplane autopilot software. What you really want is if there's an emergency, oh shit button that you need to press that lets you take over manual, it needs to get in automatically right away. And so real time means as if a transaction like that comes into the queue, you can pop the locks on everything and get it through. So there's a bunch of complexity in here, which I think would be great to have some people take a look at that are not me. And async is a beast. So what is the key trick here? Implementation wise, not very difficult. We can just remove voting from, we can remove the execution from voting. Not hard. The hard part is, how do we know that that's safe? How do we know that the block executes in time? How do we know that there's not free DA issues with invalid fee payers? All of those are, pretty much open. I'm working on some of them. Hopefully we'll have some more details.
Yeah, go for it, Brian.
Well, it is a tangent, so I don't want to stop a really, really amazing conversation. So, but Max, the question would really draw on some of your experience as you've studied other blockchains and other ecosystems. And on Solana right now, all of the transaction fee that is paid by the sender of a transaction goes to the validators for execution costs. Not a single LAMP port goes for the storage of that transaction in perpetuity. So, at the moment, it's basically just RPC providers or the foundation kind of covering the cost of long-term storage. So I'm just kind of curious if you've seen in other ecosystems how other teams have thought about long-term ledger storage, and if there's anything for us to learn.
How much does it cost? I guess it's pretty expensive for you guys.
Yeah, I mean, Big Table is a good, solid six figures a month. I mean, it's insanely expensive, and we're trying to bring the cost of that down with Old Faithful. But there's still this huge disconnect, right? That there's not a single LAMP port that's being paid for long-term storage. And so whether it's $10,000 or $100,000, it's still the same story.
And is this for the account state or for
ledger history, right? So just going all the way back to Genesis, and so the full blockchain from Genesis forward.
Yeah, I guess it's interesting because there's a lot of users who don't get any value from the history being stored, and then there's like, or maybe they indirectly like they might get value from it, but it's not excludable in that like somebody like me goes and says like, I'm doing research on the cancel take race from January, and I go and I ask Lucas from Vito, I say, can you get me like these 200-second windows on this this program? And I look at the historical, I ask, Triton for the historical data from that period, and I compare it, and I see what's going on, right? And like then I maybe make the blockchain slightly better because of that info, but it's not really excludable. So these things are like pretty hard to price. And then if one person has it, what's the marginal benefit for another person having it? I guess it's not an easy question to solve. I think like low 7 figures a year for 5 teams is, it's a problem for those teams. I'd rather the foundation just fund that and that we focus that energy on. That's like
Yeah. But so you're maybe not familiar with any thinking from other ecosystems, because I agree it's a challenge to solve that one.
Well, I'll tell you how he solved it, which is they just like go really slow.
Yeah, exactly. You can fit the whole thing on one box. Yeah, it's easy that way. Let's do that.
No.
No, we're not doing that. We solve hard problems around here. That's what we do.
Yeah, we take less than 5 to 7 years to do it.
Yep.
Any other questions? Max, this has been absolutely fantastic. Thank you, sir, for the time and the depth and dealing with all of our wild questions. You're doing great work over there. Really, really excited about the future and anything that we can do on our end. Please don't hesitate to challenge our people. It's what we thrive on, as it is what you thrive on.